Good morning, everyone. I'm your host, Anne-Marie Band. I don't know about you, but I love our intro. It always gets me really hyped up. So, welcome to the Daily Edge on the Place Your Trades Network. We are the network that focuses on trading daily options using the CME contract, event contracts to trade indices, energies, metals, and now Bitcoin. Today's broadcast is brought to you by the Trade of 8 platform, which is a custom app dedicated to trading the CME Group's event contracts. You can trade them on the custom app or using the Dome on the main platform. Today, I am really honored to get a good friend of mine, Michael Nauss, to come visit us. Wow, I actually did not ask him if that's exactly how his name is pronounced, but we've known each other for years. He is a lovely and genteel Canuck. And so, Michael, welcome to the show.
Thanks for having me. And that's a genteel Canuck. That's got to be the first time, but I like that. I'll take it.
Well, you have been around the trading space for a long while, and you've developed a unique set of skills, really, that many of us do not have. And that's really focusing on data inside of charts. So, before we dig into the nitty gritty, I'd love for folks to learn a little bit more about how you came up and what kinds of ways you interact in the market day to day.
Yeah, so sure thing. So I actually started trading way back in 2006. There was a job fair at my university. I was in there for finance. I thought I'd be a financial advisor, telling people what to do with their retirement and all that kind of stuff. But there was a prop firm that essentially, for those who don't know, a prop firm is just a firm that gives you capital to trade and they train you and all of this, and then they split the income that you make. So I started there. It was funny. The interview question was whether or not I played video games, and that was about it, because that was back before the HFTs and computerization of the market. So being fast on the keys and able to execute trades quickly was a massive, massive bonus. So I started there and I spent a couple of years working at that firm until after I graduated. Then I moved on to the hedge fund space. So I spent about 10 years doing hedge fund type work, where basically we would get contracted by investors to go look at what hedge funds actually did and how they made money, and to make sure that these were safer investments and how they'd fit in their portfolio. Mind you, this was all around the Bernie Madoff times. So, there was a whole industry that kind of popped up overnight that said, okay, nobody trusts anyone anymore. Let's actually go in and take a look at what they're doing. And I really enjoyed that. And I spent about 10 years there. And it allowed me to see from a lot of industry professionals and large institutions and hedge funds exactly what it is that they did, how they looked at the markets, how they made money across a whole spectrum of different hold times and trading styles and philosophies on the market. From then, when that firm got purchased, I actually just went on my own and started to trade my own account again. And this is when I learned that the market had changed dramatically from 2006, when, you could scalp around the trader, and it became a lot more of a algo driven, high frequency type of a market. So that's when I took my other passion, which was just looking at data and back testing things and doing this, and kind of combine that with what I had learned all throughout my career so far to trading, and started to build mathematical models and systems and that type of things with trading. And then some point along the way, you can see over on that side, I got my chartered market technician a few years back, just to kind of certify that, yes, I've stared at charts now for probably 15 years.
That's a super interesting background. A lot of us don't have experience looking inside of the particulars of hedge funds. And so, what were a couple of things you noticed that made you go,
There was two things that stood off right off the bat. One was you quickly saw how their size was a hindrance, right? A lot of times we think that, these hedge funds, they're unbeatable because they have all the technology and the best brains and the best minds. But working there for so long, I saw a very distinct pattern of a small hedge fund doing very, very, very well. And then, of course, money just thrown at this hedge fund manager, and then they ballooned to a certain size, and then performance fell apart. And that pattern just
Interesting.
repeating over and over and over again kind of really shone a light to me that us as retail people, we have a massive advantage that not many people talk about, in the fact that we can be so nimble, we can be in a position and out of position, and we're not going to infect the markets, right? Even if you're a very wealthy trader with a really large account, especially something like, the CME futures and things like this, you're never going to worry about moving the market in any significant way. That was one thing. And then the other one, which was kind of really got me into the systematic approach, was I was visiting one of the top performing funds that we looked at. And I had been to many times in New York into large hedge funds, and they had, fancy Bloomberg terminals and massive screens and tons of employees. And one time I went into this top performing fund, and it was one guy in a little shoebox office, no bigger than my office here, and one screen. And he was the first quant that I met. And again, this was around 2008,
How cool.
2010. Yeah, and I sat down with him, and he had just a normal computer, and he had one big red button. And of course, I had asked what the big red button for. He was like, that just turns off everything in case something, that I'm not expecting happens. But it was just one of the first ones that I saw that didn't look at the market from a fundamental point of view. He didn't even look at it from a technical point of view. It was all quant and numbers, and he was able to really detach himself from everything. And he seemed like he was living a way better life than the people who were, stuck in the news the whole time.
Right. Absolutely. That's fascinating. So it brings us to the topic. How would you define the term systematic trend following?
So there's a lot of different ways you look at the market. And if you look at, I would say, what the standard trader does is they have some sort of news event or story, or I think AI is hot, or I think oil is undervalued. They have some sort of story that they paint for themselves. And then they look at the chart to kind of confirm entries or exits. And I can tell you, this is how a lot of hedge funds work. You have the portfolio manager who has an idea of a sector or something like this, and then he assigns to his technical analysts, when do I exit, or when do I enter, when do I exit, where does my stop loss go, when am I wrong, all of this. The way I look at systematic trend following is you replace the story part of this with some sort of something that you've proven to yourself mathematically, whether it's relative strength or something as simple as a moving average crossover, or any kind of way that you've actually been able to kind of systematically and mathematically proven that you will have some outperformance to the market over time. And then you just apply that in a trend following nature. So as opposed to, I'm going to look for a trend in a news event or a social media event, you're saying, I'm going to look for a trend in price based off of some sort of systematic,
Catalyst of it.
yeah, back test, or whatever it is that you've done to prove yourself over time.
So I've noticed, because I've worked with traders for many, many years, I've noticed that when the average person, when you ask them, hey, have you found an edge that you can use every single time in your process that will bring you from one space to the next? And sometimes they will say yes, sometimes they'll say no. But if they say yes, how they define that becomes somewhat humorous, because they use 3 or 4 observations and they go, I'm trying that. And they don't look for any other kind of ancillary whatevers that might be floating around in the market. So although many of us think that we're systematic, we really are not. We end up being very much discretionary because we don't hold fast to a set of rules. And so I would imagine, since you've seen so much of the inner workings of very big motions, you understand that element of rule following. And so you and I talked briefly a little bit about where you were seeing relative strength in the market in terms of, hey, here's how I find an edge that might build into something like a systematic trend following event. And I'd love for you to talk about that, how you organized it, what kind of relative strength you used, and maybe what caused you to pick that up as a test.
Yeah, so first of all, you're 100% right. Most people who think they're systematic in some way are usually bouncing from system to system to system. And I find that is the hardest part of being a systematic trader, is understanding that regardless of what you do in the market, sometimes it'll work, sometimes it won't.
Exactly.
And the people that I really gravitate to, and what I always try to do myself, is someone who, if you have enough data supporting your system or your idea, you stay the course, and you stay the course regardless. Because what will happen, and I've seen this happen a lot with traders, is they go from system A, they've traded for a long time, and it starts underperforming. And then they switch to system B. And the second they did that, system A starts doing well again. And then there's this constant almost chasing of the dragon between, I was doing this, it worked great, and now it doesn't. So now I'm going to hop over here. And then you look back and you say, well, that initial system that worked great as well. And if you just kind of stuck with what it is that you designed, that worked really, really well. But my personal system, when it comes to relative strength, where the idea actually came from, was from taking my CMT and becoming a chartered market technician. They have a section there on Ned Davis Research, which I'm sure a lot of your viewers have heard of. They're a very successful research firm, and they use a weight of the evidence approach. And this is the first time I was kind of introduced this, where basically they're doing it on macroeconomics. So they're basically saying, okay, if the jobs report is positive, we're going to give the economy 1 point, and if this thing's positive, we're going to give it 1 point, and then we're going to rank the economy or the market, and then to decide whether or not we're going to trade based off of that. So that gave me the idea to say, well, what if we do this with individual names, and what if we do this with individual stocks? And this is where my consulting with Trade Ideas really helped, because they have the ability to have all these data points stored across all these stocks. So I started to play with the same kind of concept. Well, what do we define as strength in the market? Generally speaking, it's trend. Generally speaking, it's a trend that's working better than everything else at the time. So what I did is I started to build a system, and the system looks something like, if the stock is over the 200-day moving average, give it 1 point, right? If it's over its 50-day moving average, give it 1 point. If it's showing more bullish candlesticks than bearish candlestick patterns, give it some point. And by doing this and massaging it over time, what I found is that it did an amazing job of just showing me all of the time what the strongest trends were in the market at any given time. So as a systematic guy, I had to prove it to myself. So I went through and I back tested essentially what would happen if you rotated your portfolio into the strongest names, just constantly, regardless of market conditions, regardless of what's going on. I'm just going to buy the top kind of quartile of names and ignore everything else. And I found a relative outperformance to the market for the 6 or 7 years that I ran the back test. So
Interesting. Now, do you buy
yeah.
it at the first of the period, or when is that initiate? That's a fantastic idea there. But of course, we know that sometimes, well, not sometimes, prices like real estate, it's all about location. And so when we try to institute something like that, when is the pull the trigger event? When do you, right? So you build it and then it's there. When do you start buying that upper quartile?
So for the back test, you have to be purely systematic. Now, for your own trading, this is where I always say you can level a bit of, your own technical analysis into it. But for the back test, it was simply a Monday morning rotate. So every Monday morning, you would sell anything that was no longer considered strong by this metric, and then you would buy whatever was replacing it at that time. And I found that this rotation and this fast rotation, you could do it on monthly basis. I found the performance was about the same. But what it did a really good job of is understanding the news without me needing to understand the news. So during the beginning of the Russia-Ukraine conflict, it was very heavily in
Oh,
oil, and it was very heavily in wheat, and all of these things. It doesn't know any of this. All it knows is that those were the strongest names at the time. And during the pandemic, it was in your Zooms and your Pelotons and all of these work from home or whatever names that we called. And the ability for it to maintain and say, okay, this is what's going on that's really interesting, knowing the news in a way without really knowing the news, that was really the differentiating factor for me. And it goes back to the other point that I talked about with the hedge funds, is that these guys take a long time to get into and out of positions. So if they believe there is some sort of conflict with Russia and Ukraine coming, it's going to take them a long time to accumulate the oil and natural
right.
gas and wheat positions that they want. And that buying, or at least lack of selling, is what's going to make those names come to the top, as opposed to the ones that are selling off, which would be everything they don't think will perform well in the kind of next macro event that's on its way.
Very cool. So, how does the market look right now? Do you have something to show us?
I do. I have a chart right here. So as we know, the market's pretty range bound right now. It's kind of a snooze fest. But what I did for you guys is I went through the entire algorithm and every name that it spit out as of this morning's trading. And then I went through the list and I said, okay, so we're talking futures here. How can I use this stock portfolio for futures? And what I did is I took the sector that each of these names came in, and I just counted how many are in certain sectors. So how many are in, you can see the top one's manufacturing, the next one's information, the third one's oil and gas, which is probably what we'll take a look at. And by doing this, it's a way that I'm able to also use this same system to kind of get my own thoughts on the market overall. So for example, during the Russia-Ukraine conflict that I talked about, the only thing that was in it was food and gas, right? That was everything else fell off the list really, really quickly. So by doing this, I'm able to do what's called a bottom-up analysis. So a typical top-down analysis just says, let me look at the market, then let me look at the sectors, then let me look at the individual names. So you start from the top of the market and you work your way down. By using this kind of systematic approach, I can also go bottom up, and I can say, okay, if there is more of this name than that name inside the system, it will lead me to kind of believe, and it'll lead me to point to the fact that there may be something going on under the hood in this sector. So I think we're going to take a look at maybe copper, the NASDAQ, and oil, because those are the highest in that kind of name. And the reason I'm picking copper is just for the manufacturing, and then for the information section, I just have some names I'm looking down at here, but there was Oracle and SMCI, which is a semiconductor, and Meta, and all of these big tech names. So and this would be, it would be kind of interesting to see, I'm really interested in maybe a bullish bet on the NASDAQ over the next, say, week, couple days to a
Excellent.
week.
All
I
right.
think that may be an interesting way. And you don't need to necessarily have an algorithm, just for the viewers here, to do this. If you want to do a bottom-up analysis, you can go in the individual names inside of all of these futures contracts and try to get a general idea of what you think's working well. So if it's tech, then maybe we take a look at the NASDAQ and see what's going on there.
Okay. So, before we go to the charts, I wanted to ask you, um, if someone came to you to ask for help to do something like this, because you're a consultant, certainly that's available to us, correct? I mean, Trade
Yep.
IDs doesn't have you all to themselves, correct? Yeah.
Not all the time, but this, I will say, this particular algorithm is in Trade Ideas. So if you want to check that out, they call it the TI Strength Alerts. So it's in there, and it's part of a subscription. So if you want to come check out Trade Ideas, for sure. My name is, well, right below. It's Michael Nauss, CMT, and that's my Twitter account as well. So if you wanted to come chat, we certainly could do that. But yeah, it's very interesting, and I highly recommend if you are a trader out there, and if you're especially a struggling trader or someone who's just not happy with your results, to take a look at systematic trading. It definitely, I know I have quite a bit of gray in the beard, but if I wasn't systematic trading, I guarantee you'd be way worse by
Be
now.
all white.
Yeah.
Yeah. All right. Well, let's go peek at a couple of those things on my charts right here. So this is the Trade of 8 platform. I absolutely love it. And here we have the contracts that are the event contracts. Now, I talked to you, Michael, just in a cursory event, but an event contract is something that we can open during the course of a day, and then it closes when the market that we are looking at closes. So it closes every day, and it's a fixed reward event, right? Fixed risk, fixed reward. And here we are looking at copper, but let's take a peek at oil and take a look at what the oil contracts are telling us right now. I've got M over there and I've got M over here. All right. So you are suggesting from relative strength that because manufacturing is up at the top end of the range, that the baseline inputs are going to have some sort of lift on the horizon. And so I like that very much. And I also like it really because I am just a pictures kind of gal. I do like it from the daily perspective as well. This washout here came off of, I don't know, some kind of ugly CPI number or something like that. And then it's held the bounce, and they really are trying to hold off of this level. So since that was wrong, go ahead. Yes.
Yeah, sorry. I have done some testing around candles like that. And the reason I did it is the October 2022 lows, where we had that massive candle in the S&P 500. And I think that was also CPI or some number like that.
Yeah.
That when you have those washout moves, and this is the way I look at the market. I look at something like that, and you, from your experiences, that's probably a potential turning point. And I went in and tested it. And over the last about 10 years or so, every time we've had a massive washout candle like that in the market, it has marked a significant low. So it's kind of interesting that from what you're seeing and what my testing is, it seems like we're lining up there on a little bit of a bullish oil look.
Absolutely great. Now let's stop for a second and talk about how important what you just said was. And that is, over the last years, massive washout lows have formed a relative bottom. And so I see the same sort of thing. I do look at the market in terms of pictures, and there is something coming here. Now, the big thing is also whether Biden has had someone in his administration come out and say, hey, listen, we're going to, look at filling the SPR when whatever. I don't really think that happens. But if any things come back down into this region, it's certainly going to be a pinpoint. So you might say, well, Anne-Marie, I'm not there yet. How can I use an event contract in that way? And it's very simple. You set an alert for the price. And when the price comes in, you pop open your EC contract, wherever it happens to be, and you come down to wherever that number is. And it's not even, well, it's sitting up here, but you can see 1975 is really the highest that you can pay for anything. And it's not even, there's nobody up there right now. And so you can look at that and go, all right, today's the day I buy that event contract. So it allows you to use systematic trending approaches that you might think to yourself, well, wait, I got to come in every day and decide whether it's going up or down. You can, because there are also daily things that occur. But if you're looking for a real sweet spot that says, wait a second, here's my high all the way up at 82. here's my recent high at 74, I'm going to think about things from a range-based or balance perspective, where things move from support to resistance, break away, and then come back to that support or resistance. And so I would have an alert at 74. When it pops up, I know risk reward is engaged, and I can go, all right, I'm going to go to that, and I'm going to choose a no. And if I had to choose a no, I would be on the put side. These are the puts. This side are the calls. And if you go to the Place Your Trades website, you're going to see that we also have a tremendous amount of technology there that lets you see how the bids and the asks are moving within the market. So simply because you're listening to a guy like Michael that says, hey, this gives you really nice movement on a trend over time, you know where that trend is going to be at its sweetest spot. And that is going to be able to help you choose very definitively, very focused, and a very specific approach to getting involved using event contracts. I love these things. I think it's a great way to learn. And it's also a great way to practice patience, because I'm sure, Michael, as you know, we can sit down and build the most beautiful models. Mm-hmm. But if we can't sit on our hands until price comes into it, then, we're just going to be saying, well, I know I'm down. I know I should have waited. I know I should have,
And
so
that I think is one of the, if not the hardest part for most people when it comes to trend following is just what you said, is that sometimes the market is trending and sometimes it's not. And you have to be able to set your alerts. You have to be able to wait. And it's a very hard thing for traders and investors, because in the rest of life, we're taught, whether it's, the gym or a corporate job or something, the more that you do, the better, right? And in trading, it's not that. It's, sometimes the more that you sit and wait is the better. And then also the want to just point out the fractal nature of markets, right? Mm-hmm. So if my model is maybe saying oil is bullish for a longer term, that doesn't mean that you only look at it for a longer term period. There are people that use, and there are funds that I saw that use models like mine and systems to kind of bias themselves in one direction or the other. And then they use smaller time frames to actually implement that. Because, let's say, for example, oil does end up being bullish for the next few weeks and push higher. Mm-hmm. It doesn't mean you need to buy it and hold it for that period of time. It just means maybe when you're sitting down at your desk doing shorter term trades, you're only looking at that more bullish side, because you know that a bullish trend on a daily chart or a weekly chart is really just a bunch of little bullish trends on a 15-minute chart or a 30-minute chart. So that fractal nature, I think, is something really important to always keep in mind.
Absolutely. And as I telegraphed in from the daily chart to the 15-minute chart, we can see a range-based formation building right here. So you could look at this and go, all right, well, up here is where the range tends to go through. I could easily pick up that 71. Yes. I mean, just a minute ago, it was like $8. Now it's $9.50. And so you could pick it up at this price and then hold it until the day closes, or until you get to a point where you go, you know what, I'd like to have 30% profit, 40%. You can buy as many of these as you like. I think the limits run in the hundreds of them. So you can start with as little as one contract that actually spends just $9.75, or 100 contracts that's going to, make you have $975 at risk. And so that moving up into the 71, if we have this bullish pressure, we already know that we're sideways. Once it's to bounce off of the floor, we know that the price action is very likely to move further in our favor into the edge of the chart. And so again, that fractal element in the market is super important. You really can trade in any kind of framework. You just have to have a framework that you sit in. And for me, I love range-based trading. I drive people crazy. I absolutely love it because I can tell where the bid is piling in. And if it holds, I'm going to get in. And when I get to my target, do I want to get out when the chart goes to 74 and I stop at 71.50? Not particularly, but I will anyway because it follows my process. I've spent way too much time thinking, ooh, it's going to go, and then it'll rotate right over and I'll lose everything and then some. So
And
it's just fantastic.
that is hugely important because, I'm talking about my system and trend following systems, but I really do think the main takeaway is that regardless, whatever your personality is, whatever it is that you like to trade, building and tailoring your own system like that. Like, you're right, I would probably go crazy with range bound trading, but that's because I'm someone that I'm okay being wrong very often. I think these contracts are great for that because you're capping your downside. You know exactly where you're wrong. Knowing that when I'm right, I will make a multiple of when it is that I'm wrong. Some people, they can't do that. They're not okay being wrong that often, so they would want to do something that's a little bit more akin to what you're doing with the range bound trading, and saying, okay, I want to have clearly defined levels to play off of. I'm not going for the home run. I'm going for singles over and over again. And neither of those are right. Neither of those are wrong. And neither of those are better. It's kind of, what can you do? Like, what can you get away with mentally, kind of in your own way, to make sure that you can stick to it? Because regardless of what you do, you're going to have periods that aren't so fun. But if you have a system that you can just go back and rely on over and over again, that has that positive expectancy over time, then it's great. So yeah, your style might drive me crazy, but then my style may also drive you crazy. So
Yes,
it's important that you find your own.
Does often having those big breaks because I always expect it to revert to some sort of mean. Michael, it's been a pleasure. I was actually really trying to figure out the last time we actually saw each other in flesh and bone, and it's been a long time. A really long time, but it's super great to connect. Tell me what you've got going on in your world and where people can find you.
Yeah, so I have a YouTube channel. I have a Twitter account where I kind of share my thoughts on the market and any systems that I'm looking to build, and some dogs. You'll have to put up with some dog pictures every now and then, but it's all under my name, which is just, you can see below, just Michael Nauss CMT. And I have a website that's just called Stats Edge Trading, where I just
say that again.
Stats Edge Trading. So
Excellent.
It's the idea of just applying statistics to whatever it is that you do as a trader. How can we add a level of statistics to that to try to boost your edge? And you can find all of my stuff there. But I'm very easily Googleable, I guess, is the bottom line.
Well, that's fantastic. I'm so glad I got to share the showtime with you today. I think we're all better for it. I certainly am. I'm very surprised that manufacturing had the highest relative strength. I would not have guessed that, which has my wheels spinning a little. So yeah, that's fantastic. I'd love to have you back on again. We can dig down more as the next quarter rolls on and things start to rotate. You can tell us all about that, but it's time for the end of the show. Thank you.
Thank you for having me. So much fun. Anytime you want to have me back.
All right. Awesome. Thank you, Michael. And thanks everyone for watching. Come on out to placeyourtrades.com. We've got a ton of tools to help folks let you see how the market's running, and we'll see you next time.
See ya.